Welcome, ladies and gentlemen, to Commodity TV and a new edition of our online interview series. We want to get an update in the 2023 outlook of gold royalty. And David Garofalo, the CEO, is here with us. Good morning to Canada. How are you, David?
Good morning to you, or good afternoon, as the case may be.
Yeah, it is absolutely over 5 o'clock here already. And yeah, great to see you. Great. You are in good shape. And yeah, Gold Royalty, I'm a shareholder of the company. I have to disclose that up front. And yeah, maybe I bought a little bit too high, but I have a good hope that we see much higher prices, hopefully this year. So 2022, I think, was a year for setting up, consolidate, yeah, not let's say harvesting already, but really putting packages together, putting royalties together. You guys are now at 216 royalties. Jesus Christ, that's really a lot. So maybe you want to comment shortly on 2022, how you saw the fiscal year, and yeah, what was positive for you?
Well, it was our first full fiscal year. You remember we only IPO'd back in March of 2021. So this was the first full 12-month period. And we reported record revenues, incredible for a company less than 2 years in age, $5.7 million in revenue. And that's poised to grow at a rate of 60% per annum going forward. And we have such confidence in our free cash flow model that we introduced a dividend 10 months after our IPO, and our stock is currently yielding about 1.6%, with the prospect of increasing dividend over time, given that revenue growth that's likely to be crystallized over the next several years.
Fantastic. And I saw you had like 2,156 gold equivalent ounces as collecting, or call it as revenue. Where do you see this on the new fiscal year for 2023?
Well, we will be providing guidance very shortly. But as I said, that underpins the highest growth rate in revenue in the entire industry at 60% per annum over the next 10 years. By consensus estimate, our revenue profile will be approaching $60 million US by the end of the decade. And that's against a G&A footprint that's flat. You know, we invest about $5 to $6 million a year in cash G&A costs. Most of that is D&O insurance because we're listed on the New York Stock Exchange. But we have very flat G&A costs. We have eight employees, and we could run a business 10 times the size with the same number of employees. That means every incremental dollar of revenue growth is going to go right to the bottom line and increase the potential for us to improve our dividend over time.
Okay. In December, you acquired 12 new royalties in the ABTB Greenstone Belt. I would say one of the most famous mining regions in the world, definitely. And yeah, you entered the agreements, of course, to generate future royalties. Where do you see, let's say, a focus there? How fast do you think you can develop revenues out of that?
Well, look, we are heavily concentrated in the three best mining jurisdictions in the world: Nevada, Quebec, and Ontario. 75% of our royalties by number and by value are in those three jurisdictions, judged as perennially as among the top 5 in the world for geological potential, low political risk, and low regulatory risk. So we're in good hunting ground. Those 12 additional royalties were part of an effort by us to offload exploration properties and take royalties back. Our model is never to invest exploration in the ground. Our model is to harvest royalties from those exploration opportunities. So we would never contaminate our model by investing and taking exploration risk. We really leave that in the hands of the operators, the explorers, and developers. Our job is to harvest the returns over time, collect the checks, if you will, as these projects are de-risked and developed. That's the beauty of the royalty model, is it provides you full leverage to the gold price upside, full leverage to the exploration success of our operating partners by completely insulating you from exploration cost risk, operating cost risk, and capital cost risk.
Absolutely. If I look at your very impressive list of let's call it large royalties you have, or meaning with large companies. There's, for example, the Odyssey project where you have with Agnico Eagle and Pan American. I mean, world-class companies. You have been long time with Agnico Eagle, for example. The Côté Gold project with IAMGOLD, Ren, Granite Creek, Jared Canyon, First Majestic. I mean, this is outstanding. So what do you expect from those, let's call it big boys, for the next years?
Yeah, no, it's an excellent point because it's not just a quantity proposition. Yes, we have one of the largest, most diversified portfolios in the entire industry. It compares to what the seniors have in the royalty space, but it's not just a matter of quantity. We also have high quality. You pointed to the fact that we have a royalty on the Odyssey Underground, which is part of Canadian Malartic, Canada's biggest producing gold mine, operated fully by Agnico Eagle now after its takeover of Yamana. We have a royalty on Côté, which is IAMGOLD's new mine, which will be operating next year. It will be Canada's second biggest producing gold mine. And then we have a royalty on Ren, which is the underground extension of Goldstrike, operated by Barrick in Newmont, Nevada. So not only do we have generational assets with multi-decades of reserves ahead of them, high grade, high profitability, and also significant royalties on them, but we have partnerships with the biggest gold companies in the world. And I think that should provide a lot of comfort to our shareholders because we have well-capitalized partners that have the wherewithal financially and technically to advance and optimize their projects and mines so that we get optimum revenues and royalties from those projects and mines.
Okay, super. We got 3 questions from viewers, which invested right after the IPO, which was at $5. So today we are half the price, 240, 248, 250. What is your answer to them? Why do you see the share price halved since the IPO?
Well, the share price performance last year was abysmal. The entire sector had a very difficult time, and I think we were disproportionately affected. And there's really no fundamental reason for that. We introduced a dividend, we grew a royalty portfolio, we maintained a low share count, we created per share value. We've never been more discounted than we are now, but there's nothing fundamentally that is causing that. In fact, all of our 215 royalties are bought and paid for. We don't have any capital calls on them. We have a pristine balance sheet with virtually no debt. We have good cash. We have access to additional credit lines if we need them with Bank of Montreal if we're looking for further acquisition. So we can readily raise capital if we want to add more to the portfolio. But effectively, all we need to do is harvest the revenue, the royalties from this vast and diverse portfolio, high quality portfolio in the best jurisdictions in the world. It requires no additional capital from our shareholders. So we're in an excellent position, as I said, not only to maintain the current dividend, but we believe we'll be able to grow it over time as all of that incremental revenue goes right to our bottom line.
That's great. I like the word harvesting because you know what it means. Like I'm from Stuttgart originally, so I'm a Schwabe. Yeah. You know how a Swabian guy swims?
No.
He swims like this. That's what you got to do this year. That's great in the next years. No, but I'm joking. No, fantastic. I mean, I see it the same way. The share performance is nonsense to me with like a lot of other companies also with which have great quality. Given the fact or the news, what we saw the last weeks and months is with Peru, with Chile, with several other locations in South America, Brazil, for example, Argentina sometimes. How do you see the future of the royalty business? Will it be more concentrated on safe jurisdictions, or do you think companies are still willing to take that risk?
Well, in this fraught political environment that we're experiencing globally, whether it's in Europe where there's a war, again, it's hard to believe, whether it's social unrest in Latin America, it really highlights the importance of being in the best jurisdictions in the world, not only from the standpoint of geology, because there's great geological districts in Russia, in Peru, in Venezuela, but there's no rule of law. What we have in Nevada, what we have in Quebec and Ontario is rule of law, low political risk, low regulatory risk. Mines can get permitted. People are used to seeing mines in those areas. They operate them responsibly. We have well-capitalized partners in those jurisdictions. We have by far the lowest risk royalty portfolio in the entire industry. And I think that's a unique competitive advantage and puts us in a position, I think, to get a premium valuation as we deliver that revenue growth over the coming years.
And I think with that portfolio you have, even if you would decide to say, hey, you know what, we wait until all those unrests are over, we are not adding any new royalties for the next 3 years, you still have the growth path, right?
That's exactly right. And again, those royalties are completely bought and paid for. That growth that we're forecasting, that the market is forecasting, is based on proven and probable reserves, not on any speculative ounces there. And it's with very well capitalized partners. We have 8 royalties that are currently cash flowing. We have another 15 in various stages of construction and development with extremely well capitalized partners. And that's extremely important. That means that revenue growth has very, very high probability of being realized.
Fantastic. Last question, because you are an industry giant, I would call it. You are a mining veteran to me. And what a lot of our viewers always ask us, hey, what are the CEOs thinking of the gold and silver price? Where do you see it this year, or maybe for the next 2 years?
Yeah, I think gold goes to $3,000 an ounce this year. And the reason
this year already?
Wow. Yes, I do. Well, it's only January, actually, early February. So I don't think it's a stretch to say that we're going to have a very violent upward movement. Central banks globally are already signaling a grand pivot. We've seen the Bank of Canada signaling they're stopping raising interest rates. The Federal Reserve just yesterday said maybe a couple of small hikes, but we're pretty much done. I think they've overcompensated. The increase in interest rates over the last year has been unprecedented. It will drive economies into a deep recession, and they will overcompensate. They're less concerned about inflation now than they are about economic growth and maintaining economic growth. And central banks have a dual mandate. It's not just about containing inflation anymore. They also have to maintain full employment. That's a big change from what we experienced in the last big inflationary cycle in the 1970s, where central banks were singularly focused on inflation. That's not the case anymore. They will use that as a pretext, softening labor markets to probably decrease interest rates more quickly. And they need inflation because the amount of debt that we have as a society is 3.5 times expressed as a percentage of GDP to what we saw in the last inflation cycle in the 1970s. It's 350% of GDP versus 100% in the 70s. So they have to inflate that debt away. They want inflation. There's no fiscally responsible way for governments to repay that debt. There will be a large fiat currency reset, and gold is the one currency that can't be printed. When that happens, gold will exceed the real all-time highs that we achieved back in the 1980s, which was a little over $800 an ounce, but inflation adjusts that to 2023, that's over $3,000 an ounce.
Yeah, definitely. And the little brother silver?
Well, silver has the potential to outperform gold. Typically, in a bull market, the gold to silver price ratio is 40-1. It's approaching 80-1 right now, and that's because we've been in a bit of a bear market the last couple of years. So what I think will happen as gold rallies dramatically, silver will outperform it, and you'll see that spread, that ratio narrow dramatically. So silver has the potential to go to $100 an ounce if we see $3,000 an ounce gold.
Love it. I love those predictions. I hope you are totally right. Super. Yeah. David, thank you very much. That was a great update and insight. I'm pretty sure we talk quite soon. And yeah, I would say keep it going and just make sure you are harvesting.
Thanks, Johan.
Thank you very much. Yeah, ladies and gentlemen, that was David Garofalo, the CEO of Gold Royalty. You heard it, 216 royalties and 60% annual growth over the next years. This is really outstanding. And yeah, the company is really making money. The company is paying a quarterly dividend by now of 1 cent. Probably this might rise also within the next quarters and years for sure. And the company is doing really a fantastic job in safe jurisdictions. Make sure you have a very, very close look on Gold Royalty, and even better, make sure you own some. Thanks for watching us, and bye-bye from Switzerland.